Welcome. Welcome to Investing 101. Alright. Investment strategies for financial growth and security, the essential methods for enhancing personal wealth. The agenda overview introducing to investing, investment vehicles, risks and return, investment strategies, building an investment portfolio, common investment mistakes and how to avoid them. Introduction to investing, definition and importance of investing. So this is just an overview. The next video coming up, we're gonna go even deeper into investing and finance. All right, so investing is a crucial strategy for building wealth over time, allowing individuals to accumulate financial resources. Outpacing inflation through investing, individuals can grow their money at a rate that outpaces inflation, preserving purchasing power. Financial security, investing helps provide financial security for the future and ensuring a stable income and resources for unforeseen circumstances. When it comes to investing, wealth building, there's like three categories that we kind of look at, and those are real estate or property, and then there's the stock market, and then there's businesses. Those are like the three areas that we all kind of look at. So that's just something to note. Outpacing inflation. So if you keep your money just sitting there, not moving, not investing it, not doing anything with it, if it just sits there in a bank or maybe you put it or you have somewhere at your house where you store it or something of that nature. Basically, inflation eats it up, basically, right? Your money is worth less. It's basically what that means when we say inflation. All right, moving on. The basic principles and objectives. Time value of money. Understanding the value of money is crucial for effective investment planning as it affects the growth potential of investments over time, risk and return relationship. Investors must understand the relationship between risk and return to make informed investment decisions that align with their risk tolerance, and then they're setting financial objectives. Having a clear financial objective is essential for guiding investment choices and measuring progress towards achieving those financial goals. Um, Risk and return relationship. So something you would hear a lot of investors say a lot is ROI, which is the return on investment. Um, so just take note of that. Also, when it comes to risk and return, the bigger the risk, the bigger the reward. If you haven't heard it before, you're hearing it now. And then also the bigger the risk, also could also mean the opposite, right? The bigger the reward, but it also could mean the bigger the loss. So that's something to keep in mind. Uh, Type of investments: stocks, bonds, real estate, and mutual funds. Stocks represent ownership in a company, providing potential for high returns, but also come with higher risks. Bonds are debt securities that provide fixed interest payments, generally lower risk, but with moderate returns compared to stocks. Real estate. Investments involve purchasing property for rental income or capital appreciation, often requiring substantial capital. Something also to note about real estate is that you could also use depreciation, and then there's also tax loopholes with real estate. If you ever heard of people that don't pay taxes, a lot of times it's because of property. They own a lot of real estate or property. Um, and so that's what real estate can do for you. Mutual funds, they pool money for multiple investors to invest in a diversified portfolio suitable for risk-averse investors. ETFs also do something similar to that also. Let me see. Stocks and bonds. Understanding stocks. Stocks signify ownership in a company, providing potential dividend income and appreciation. in value over time. Understanding bonds. Bonds are loans to corporations or governments, offering fixed rate interest payments and a return of principal at maturity. And risk and return profiles. Stocks and bonds have distinct risk and return characteristics, making them essential for a balanced investment strategy. All right, mutual funds and ETFs, investing, pooling. Mutual funds and ETFs enable investors to pool their resources for collective investment opportunities. Diversification benefits. These investment vehicles provide diversification, reducing the overall risk associated with investing in individual assets. People always diversify. Diversifying is the way. Unless you just want to take the risk of if the market go down and you have all your money in one place, yeah, you can lose a lot of that money. Professional management. Mutual funds and ETFs offer professional management, allowing investors to benefit from expert financial strategies and decisions. Real estate and commodities. Benefits of real estate. Real estate investments provide potential income through rentals and appreciation over time, making them attractive to investors. And don't forget depreciation and tax loopholes. All right, role of commodities. Commodities such as gold and oil can act as hinges against inflation, providing stability in an investment portfolio. Portfolio diversification, including real estate and commodities in an investment portfolio, adds diversity and can reduce your overall risk. Risk and return. Understanding risk and return. The definition of risk is the potential for a loss in an investment, representing the uncertainty of financial outcomes. Um, Understanding return. Return is the profit generated from an investment, reflecting the success of financial choices. Balancing risk and return. Investors need to find a balance between risk and return that aligns with their financial goals and risk tolerance. Diversification benefits. Um, Diversification helps reduce risk by distributing investments across different asset classes. This way, potential losses are minimized. People, please diversify. Mitigating losses by spreading investments, not all will be affected by market changes, helping to mitigate overall losses. Like the last big, like real big hit the stock market took was back in 2008, I believe. It was like around the end of, I think it was it President Bush's term, his last term. So that's sort of like when that happened. It was sort of that. Well, it dealt with a lot of things, but I'm not gonna get into that on this particular video. Responsive investments. Different assets tend to respond uniquely to market changes, ensuring a balanced portfolio. Assessing risk tolerance, understanding financial situations. Investors should evaluate their current financial status, including income, savings, and expenses, to determine risk tolerance. Identifying your goals. Clear investment goals help investors understand the level of risk they are willing to take to achieve their objectives. And then your personal comfort with risk. Assessing personal comfort with market fluctuations is essential for aligning investment strategies with individual risk tolerance. So, personal comfort, and another thing to pay attention to is emotion. When it comes to investing, not being emotional is your number one asset, right? It helps you make better decisions. So, no emotion equals better decisions. All right. Long-term versus short-term investing. Long-term investing involves holding assets for years, allowing for compounding growth and potential higher returns over time. Short-term investing aims for quick profits, often involving more frequent trading and increased market risk. Most people will tell you long-term investing is safer. So if you talk to most investors, I'm pretty sure there's somebody that's gonna tell you that short-term investing is cool too. So I guess it depends, but most people I believe will tell you that it's safer to do long-term investing. Advantages and risks. Both investing approaches have their unique advantages such as growth potential and quick returns, but also come with specific risk. Growth investing versus value investing. All right, so growth investing focuses on companies projected to experience above average growth in earnings and revenue. Um, so growth companies, right? When you invest in them, they don't give out dividends. What growth companies do, they put the money that you give them, they put it back into the company. So that's something to note. Most, like if you want an example of a growth company, most tech companies are growth companies. So like a Snapchat, or I think actually Meta just announced that they're giving out dividends not too long ago. So they kind of switching up or trying to change a little bit. But for the most part, they're still growth. Um, most companies, most tech companies are growth. Um, Tesla, I think, is still considered growth. Um, value investing, value investing seeks stocks that are undervalued in the market, aiming for long-term gains as value is recognized. Um, your value companies are usually your more mature companies, so that's something to take note. Market trend analysis. Both investing strategies require careful analysis of market trends to make informed investment decisions. Active and passive management. So active management requires frequent transactions to potentially outperform the market, creating opportunities for higher returns. Passive management aims to mirror the market returns through investments in index funds, typically resulting in lower costs. And the costs and benefits, understanding the costs associated with each approach helps investors choose the right strategy based on their goals and risk tolerance. So when you think of passive management or just passive investing, you're basically talking about just putting your money into uh, to an asset and just letting it grow and like not paying attention to it, right? So sort of like so on this example, it says index funds, but ETFs could be something also. Um, you're just putting it into the market basically, and there's ways to automate it also. And so you're doing it passively, right? You're not really paying attention or doing anything that's active. So setting financial goals, establish clear goals. Investors need to define specific, measurable financial goals to effectively guide their investment strategies. Measurable objectives. Setting measurable objectives allows investors to track progress and to make informed decisions based on their financial targets. Diverse goals. Goals can vary widely from retirement savings to funding, education, reflecting individual priorities and timelines. Asset allocation and diversification. That's that word again. Diversification. Understanding asset allocation is a process of distributing investments across various asset categories such as stocks, bonds, and cash, balancing the risk and reward. The goal of asset allocation is to balance the risk and reward according to investors' goals and tolerance. Importance of diversification is spreading investments within asset categories to reduce the risk and minimize potential losses. Monitoring and rebalancing. All right, so when we're monitoring, it ensures the portfolio aligns with your evolving financial goals and objectives over time. When you rebalance, it helps to manage the risk by adjusting asset allocation based on your tolerance and the market conditions. Optimizing the performance regularly, reviewing and rebalancing your portfolio can optimize the performance to achieve better returns over time. Common investment mistakes and how to avoid them. Emotional investing and market timing. Emotional investing is often driven by fear and greed, leading to irrational financial decisions that can hurt investments. Um, Something you will hear from a lot of people is when people are greedy, that's when it's time for you to be not greedy, right? To be fearful. And when people are fearful, that's when you should be greedy. Market timing challenges. Attempting to time the market can lead to missed opportunities and increased risk, detracting from long-term investment success. Um, some people will tell you that being a contrarian is the best way to invest. So that's something to keep in mind. Importance of discipline. A disciplined approach is investing helps mitigate the emotional decisions and improves overall financial outcomes over time. Lack of research and due diligence. The importance of research. Um, so when doing research, a lot of times you will hear people talk about the fundamentals, the technicals, um, and evaluating the company. Um, yeah, conducting thorough research is crucial for making informed investment decisions, avoiding pitfalls, and maximizing returns. Understanding investments, investors must understand the underlying factors of affecting their investments, including market trends, economic indicators, and risks. The consequences of inadequate due diligence. Failing to conduct due diligence can lead to poor investment choices and significant financial losses. So technical analysis is basically like you're looking at charts and you sort of like you can see like where it's trending, right? The company, and then finan fundamental analysis is sort of just um, looking at the fundamentals, right? The paperwork. Let me see. Overconfidence and underestimating the risk. Overconfidence in investment decisions can result in complacency, ultimately leading to significant financial losses. The importance of humility. Investors should approach the market with humility, recognizing their limitations and the unpredictability of investments. Continuous education. Staying informed and educated about market conditions is crucial for market sound investment decisions and mitigating risk. All right, and I think this is the last one, advanced investing, but I'm gonna go much deeper on finance and investing in some of my next videos. But call option is a financial contract that gives the buyer the right, but not the obligation to buy a stock, bond, a commodity, or other asset at a specified price within a specified period. So call option, you're sort of like betting that the company is going to, or stock price is going to go up, basically. Put option is a financial contract that gives the buyer the right, but not the obligation to sell a specified amount of an underlying asset, such as a stock, bond, commodity, or other security at a predefined price within a specified time frame. So with a put option, you're sort of betting that the company's stock price is going to go down. We usually use put options as protection, right? Protection, or some might even say insurance. The stock price is investing in a predetermined price at which the underlying asset of an options contract can be bought or sold when the option is exercised. And I so got to get that period out of there. I don't know why I did that. I'm pertaining to the period and sold, by the way. Iron Condor is a sophisticated options trading strategy designed to profit from low volatility in the market. Bull put spread, selling a high strike put and buying a low strike put, creating a credit spread that profits if the stock stays above the short put strike. Bear call spread, selling a lower strike call and buying a higher strike call, which generates a credit and profits if the stock stays below the short call strike. All right, in conclusion, knowledge is key. Investors need to educate themselves about various investment options and market dynamics to make decisions. Strategic planning, developing a solid investment strategy is essential for achieving financial goals and maximizing returns. And discipline and patience. Successful investing requires discipline to stick to the strategy even during market fluctuations and challenges. All right, so that was a quick overview of investing. Thank you, and I will talk to you out in the next video.